All right, welcome back. Joining us virtually is our local CPA, Robin LeBlanc. Robin, good afternoon. Thank you so much for being here with us virtually.
Good afternoon. I'm glad to be here.
All right, so today's tax tip, itemized deductions. What do people at home need to know?
Okay, so itemized deductions have been around for a long time, and they are commonly misunderstood about what you can use them for on your tax return. These are a combination of expenses that you have throughout the year that you get to use the higher of the standard deduction or all the combined expenses related to the itemized deduction. And you do whichever one is more favorable to you. So this can actually change from year to year. Itemized deductions include medical expenses, the state income taxes withheld from your paycheck, or any prepaid state estimated tax payments you made. If you didn't pay in any state income taxes, you can actually use the average sales tax that you paid in the year. Also, your property taxes for your house paid to city and parish. Mortgage interest on your house, investment expense, charitable contributions, and an unknown one is gambling losses. So if you are at the casino every weekend and you have an extensive amount of gambling losses, you can actually include those in your itemized deductions to the extent that you have gambling winnings.
Okay.
Now, whether or not you're going to use these itemized deductions or standard deductions is also based on your filing status. So a single individual has the filing status, has the standard deduction of $12,550 for the tax year 2021. So if these combined expenses that I mentioned are in excess of that $12,000 amount, you may benefit from itemizing your expenses. So it's keeping track of these throughout the year. Medical expenses is a big one, but a lot of times people don't like to keep track of all these expenses. Your pharmacy and your healthcare providers can usually print you a statement at the end of the year instead of keeping track and trying to add up individual receipts. Now, the thing to worry about with the medical expenses is you only get the benefit of what's over 7.5% of your adjusted gross income. So if you're a single individual with a $50,000 adjusted gross income, you would need to have over $3,750 worth of medical expenses for the next dollar to actually account. So they changed the law in recent years to make this harder to itemize, but it's still important to be aware and track these expenses.
Awesome. Well, Robin, this was a great tax tip for today. Thank you so much for sharing this with us.
Thank you.
Of course, and if you at home want to rewatch everything that Robin just talked about, head to our website, klaf.com. Everything will be posted there. Before we go to break, though, we got to check in with Adam Olivier.